names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
High-end conversation about Travis Kelce in the commercial break that you don't need. Believe me. Your equity market futures bouncing by 0.3% on the S&P 500. On the Nasdaq up by about 0.25. 3-month lows on the S&P, the lowest since June 7th. We're trying to bounce. Let's your opening bounce, switch on the board and get to the bond market. Bonds taking a bite out of this equity market worldwide. Yields on a 10-year. Cycle highs over the last couple of days. 451, pulling back a couple of basis points this morning. In the FX market, the dollar strength sticks. The euro weaker, 105.31. On euro dollar, negative 0.4%. The dollar at the strongest point of the year so far. Dollar yen pushing 150, 149.20, and crude. Even with the dollar strength, commodities breaking out 92.38. Crude right now up by more than 2 percentage points. That's the cross-asset price action. Your opening bell about 30 seconds behind us. Your equity market open looks like this on the S&P, up by 0.3%. On the Nasdaq, up by 0.4%. One stock to watch at the open is Paramount, the company in focus after the Screenwriters Union approved a new contract with the studios and ended their strike. Other Hollywood-tied stocks, including Warner Brothers, Disney, Netflix, also taking center stage. Abby has more. Hey, Abby.
Hey, John. Well, at 12:01 LA time today, the 5-month dispute, bitter battle between the Writers Guild and the big entertainment companies, it ended as the Writers Guild, screenwriters, did approve a deal. Now, they got the 3 big demands that they wanted. First, they got a pay boost. They also have a piece of the action for some of the streaming shows that do especially well. Second, shows will have appropriate staffing level. And third, they've received a reassurance that AI will not be replacing their jobs. Now, the stocks are up modestly this morning. I think, John, what folks, investors are really waiting for is the possibility that this deal could suggest that the SAG strike, this, of course, is the first time in more than 60 years that both of these entertainment unions had gone on strike together, that it will be resolved. And that could really help out Warner Brothers and Paramount in particular. Since the strikes, these 2 strikes have started, roughly Paramount down 50%, Warner Brothers down about 20%. So an overhang could be removed. And right now, we do actually have a pretty decent rally, up more than 1% for most of these stocks.
A decent pop there. Abby, thank you. Early days, about 2 minutes into the session. Let's turn to EVs. Rivian gaining after Baird analysts named the company, quote, a bullish fresh pick. We see Q3 deliveries as a near-term catalyst and expect sentiment to improve. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. It's been a short-lived open for Rivian, now basically flat, having been as high as 1.8% following the market open. Yesterday, the stock jumped by the most amount a month after that RBC note. What they're focused on is quarterly production and delivery figures. You'll remember that Rivian recently raised guidance by a modest 2,000 units to say they will produce 52,000 electric vehicles this year across their 2 consumer brands and the delivery van that they build for Amazon. But there's always been a debate about how conservatively Rivian's been playing this. You'll remember, John, that I reported in March that Rivian had told staff that its manufacturing blueprint, its plans, showed that they were capable of building 62,000 EVs this year, 10,000 more than they're currently guiding. So the question, I guess, is how much further above guidance they're going to go. This is an EV name, pure play, that is kind of not in the same category as the other startups that have struggled. But remember that they have a plant in Illinois that is capable of building 3 times what their current guidance is. There are questions about demand, but recent commentary from executives, the CFO and CEO, at investor conferences has been quite bullish about the demands that's out there, particularly bearing in mind that the two consumer brands carry a premium price point. This stock's up 22% year to date, John.
Pretty muted price action this morning so far. Ed, thank you in the first 3 minutes of the session. Let's shift to retail. Costco fluctuating despite an earnings beat. The big box giant staying silent on the timing of its increase in membership fees. Simone Foxman on this story. Hey, Simone.
Hey, John. Yeah, Costco pointing now a little bit higher after some post-market losses after these earnings came out yesterday. There's a bit of a mixed bag here. Earnings per share beat analyst expectations coming in at $4.86, but comp sales coming in a little bit weaker than anticipated, especially when you include the impact of currency and gas. Overall, we're looking at 1.1%. The street had been looking for about 1.8%, especially seeing a little bit more weakness in the United States. The company's saying it's seeing those customers trade down. Big ticket items purchases still weak, so a lot of the interest there on the lower margin stuff, the food and that sort of thing. Shrink, however, not a big issue for Costco. Markets have been focusing, and maybe we're focusing yesterday as we saw some of those post-market losses, on what was not being said. The company did not talk about a fee hike. That is something that some analysts wanted, but people in the store is encouraging traffic growth more than double what Wall Street had anticipated, and the number of paying card holders coming in at 71 million. Again, that's up almost 8% from a year ago. Read those fee hikes, the CFO saying it's a question of when, not if. Surely markets would like that to be sooner, but we're already looking at shares up 21%
This smoothie is a metabolism
The hot dog is still
killer.
$1.50.
This cookie is a metabolism
All right,
killer.
so still
And even this
$1.50.
burger
You know, I
is a
haven't been to a
metabolism
Costco
killer.
and bought a hot dog recently. so
Okay,
I
that's a
don't
big deal at
say I know.
Costco. Anyway, Simone, thank you. Thank you very much. Let's stick with Costco. Cowen raising its price target on the stock to 680 from 600. Analyst Oliver Chen saying this: we believe Costco is well positioned to continue delivering robust earnings growth over the near to medium term, driven by square footage growth, membership revenue growth, and industry-leading comps growth on strong physical and digital momentum. That stock is up by about 0.1%. Want to turn to entertainment. AMC expanding a screening of Taylor Swift concert film to more than 100 countries beginning October 13th. Katie Greifeld has this. Hey, Katie.
Hey, John. Yeah, great news. If you can't catch it in North America, like you said, about 100 other countries will also screen Taylor Swift's Eras Tour moving beginning October 13th. I'm sure I'll see you there. Now, tickets for the international locations, they went on sale yesterday, and prices vary by country. And this is a big deal for AMC. Remember, when this movie about the tour was announced last month, it was met with record-breaking demand. It actually, in the first day, saw $26 million in ticket revenue, and that is the highest advanced sales revenue in AMC's 103-year history. And AMC, it needs some good news. Remember, the company announced plans to sell up to 40 million shares earlier this month after getting those court approvals. That has shares down 37% this month alone, and not a single analyst tracked by Bloomberg has a buy rating on the stock. But the Taylor Swift movie coming soon.
You're not going to see me there, Katie.
I don't know.
Just for the record, you're not.
She's the voice of a generation, John.
It's not going to. Okay, Katie, thank you. Thank you. Katie's going to be there, basically, is what you're hearing there, based on that delivery. Katie, thank you. Let's turn to the bank. Serious story. Not that that wasn't a serious story before I start getting hate mail about Taylor Swift. Bloomberg learning that the U.S. Justice Department is stepping up its probe of Credit Suisse and UBS over suspected sanction breaches. Shanali Basak has the latest. Hey, Shanali.
John, when you look at what is happening now, you have the Department of Justice going to UBS officials and saying that there are these suspected violations when it comes to Russian clients over at the Credit Suisse Wealth Manager. Now, this is a classic problem. When you buy somebody's house, you don't know always what's in it. The UBS CEO Sergio Armati has moved very quickly through the summer to resolve a lot of outstanding investigations when it came to Credit Suisse, amounting to fines in the billions of dollars. We're talking about fines tied to Archegos, fines tied to pre-2008 RMBS matters. So coming into this new era of a potential new investigation that is still in its early stages leads to an overhang for Sergio Armati that is quite unwelcome. Now, we don't know the scope of what this could cost them in the longer term, but remember, as we've been saying, this is in the early stages of an investigation, and it ties back to a larger issue that the Department of Justice has privately voiced. According to Bloomberg's Hugo Miller and Ava Benny Morrison, this is a frustration at seeing Switzerland not doing enough to enforce sanctions when it comes to Russian individuals in this era. So we have a larger issue at play, and UBS is certainly caught up in it.
Shanali, just help me understand this a little bit more. Are these failures at Credit Suisse, which ultimately UBS inherits? Or is UBS in the firing line as well for things they've done previously before this acquisition even closed?
It's a little bit of both. According to our reporting over at Bloomberg, it's largely Credit Suisse. You have to remember, UBS apparently, according to my own sources as well, has known that there could be issues in the wealth manager when it comes to their clients. They didn't know the extent of what all those issues would be. And UBS itself, they are looking at UBS. Remember, this initially started as a sweeping kind of a set of requests to a larger set of banks. UBS is definitely being looked at as well, but largely these issues are tied to Credit Suisse.
So, Shonali, as far as I understood, Sergio Ramotti and UBS gave up that state guarantee for legal fees that they agreed to several months back in the spring when this deal was basically explained to us all. Shonali, why did they do that? Did they not have a decent understanding of where this might be going?
Yeah, they did not. And that it was part of the problem. Remember how quickly this deal came together, John? There was a very implicit understanding. I also will have to say that for all of these companies that are pushing so heavily into wealth management, this is the ugly side of wealth management. And it is something that Sergio Ramotti, Colm Kelleher, they know that this could be an issue moving forward. They did not know the extent of the issues. And again, this is another thing that they could face as an overhang for months ahead.
Our chief Wall Street correspondent, Shonali Basso, breaking that down for you. About 9 or 10 minutes into the session, that stock, of course, trading over in Swiss trading. But here in the United States, we're down by about 3% or so. I want to turn back to tech. Amy Wu-Silverman of RBC Capital Markets noting a decline in, quote, tech exuberance, writing this: when we dig into what the options market is pricing for mega cap tech, it is mostly that bullish sentiment has waned. Amy Wu-Silverman joins us right now, I'm pleased to say. Amy, you were warning about higher volatility. Here it is. Is there more to come?
Here it is indeed. And yes, unfortunately, I think there is also more to come. Look, even if we strip out everything that's going on, John, UAW, debt ceiling, geopolitics, it's just seasonally a very strong month for volatility in October. Going back 20 years, this is typically a time when you see volatility picking up. And unfortunately, we have a lot of muddle through catalysts to go through, which suggests to me that we're still going to get that bid in volatility.
Got all these headline risks on the horizon, including the shutdown. Is that something you're focused on at all, Amy?
Yeah, unfortunately, I wish I didn't have to. I feel like we watch this movie again and again and again. And we kind of have to just go through it. But I just want to remind folks that, in 2011, this was an issue that brought the VIX to 45. I don't think we're going to get there, but the problem is because there is historical precedent for some of these spike type events, you just can't ignore it. You have to muddle through with it. And hopefully it's something that we can just digest. But until we actually do digest it, the market certainly has to price that into its volatility surface.
Amy, Mike McKee was on the program a little bit earlier this hour, and he was talking about the data points we might not get if the government does shut down. Does that, do you think, put even more emphasis on the bank earnings we get later in October, in the middle of next month?
It certainly does. And the other thing I think it does is it's going to change what we seasonally expect in the later months of the year. So just as October of the last 2 decades is a time where volatility picks up, usually we get a decline in volatility in November, December. But if we're going to push forward these data points and you're going to get them all at once later in the year, unfortunately, I think the market has to brace itself for even a higher VIX in those later months as well, John.
With that in mind, what are you advocating for with clients at the moment? What are you suggesting they should do?
Look, this has been a struggle for, I'd say, at least the last 2 years, where put skew has been underperforming and hedges haven't really been doing well. I think the major difference now is if you look from 2 months ago to now, folks have jumped in the pool, so to speak. There's much more participation in areas like mega cap tech or just overall in the market than there was before. And so, look, you have something to hedge, and those hedging levels have been extremely low this whole time. And I know that's sort of a boring thing to talk about, but at least there are events now to catalyze that low volatility where I think that didn't exist in the summer.
What have they been hedging, Amy, when you think about it? I know you've picked out, let's say, Apple and the bearish sentiment around that name. Is that about rates in the bond market? Is that about China? What is that about?
Yeah, so it's interesting. In Apple in particular, this is a name where if you look at mega cap tech, if you look at that Magnificent Seven, most of what we're seeing in option sentiment is just a decline in exuberance. So folks just aren't that bullish anymore. Whereas in Apple specifically, you are seeing hedging. You've seen that even with the 10% move down in Apple. I think that's very China related. But I also think it's the fact that, again, you had that massive move in participation. And now because you have that length, that's continuing to be there as you get data points in China. The other areas we're seeing are stratified. So you're seeing hedging in Canada, for example, and you're seeing hedging at other parts of the market like the credit-related ETFs, but it's all stratified hedging, John. It's nothing where I can say the full-on market level SPY, IWM, they're seeing a lot of pickup in demand there.
I think we can all appreciate how frustrating it is to talk about the potential for a government shutdown. Amy, appreciate the update. Amy Silverman there of RBC on the potential for a shutdown and everything else going on at the moment, looking for higher volatility. About 14 minutes into the session, equities up here by 0.25% on the S&P, on the Nasdaq bouncing back by just 0.5%. Coming up, we'll talk about it. Lawmakers scrambling to avoid a shutdown.
We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Team coverage coming up next.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
We'll be bringing up 4 of the appropriation bills we've been trying to do since July. Finally, we got the members together to be able to make that happen. If we're able to finish those 4 along with the ones we already, that would make it 73% of all the discretionary funds that we're supposed to appropriate for this time. We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Speaker McCarthy fighting for his party's votes as the House and Senate charge ahead with rival spending bills. The U.S. still on track for a government shutdown at the end of the week, despite incremental progress. President Biden playing the blame game, saying, quote, funding for the government is just a basic responsibility. It's time for Republicans in the House of Representatives to start doing their job. Economic fallout of the potential shutdown expected to grow the longer it lasts, impacting everything from federal salaries to GDP to the next Fed decision. Let's get your team coverage. Bloomberg's AMH in Washington. And Ira Jersey. Anne-Marie, where is this one going?
Well, Jonathan, as you said, it's incremental steps at the moment, baby steps to potentially keep the government open. But the track that they're on, it does look very likely that the government will be shut down come October 1st. So you have two different issues at play here. One is the Senate side, and they are putting forward their own stopgap funding bill. I call it very vanilla in terms of what's in it. Keeps the government open just 6 days before Thanksgiving, so through November. And it does come with some Ukraine aid and some disaster relief aid. The issue is Speaker McCarthy can't put that on the floor because those hard right members of his party, like Matt Gaetz, already says that there'll be a motion to vacate, a.k.a. fire him. So what Kevin McCarthy is trying to do on the House side is show goodwill to some members of his party. They were able to get through late last night just getting bills on the floor to debate. That's something he wasn't able to do last week. And he says once that's through, these are full year spending bills. Once that's through, they'll look at a continuing resolution, a stopgap measure. But it comes with deep cuts in discretionary domestic spending, as well as immigration provisions that the Democrats will not sign up for. So then there's potentially this third option, Jonathan. It's called a discharge petition. And what you could see is some Republican moderates signing up with Democrats basically over Speaker McCarthy's head, taking control of the floor and voting through pretty much a clean stopgap measure. The issue is, Jonathan, this has happened only twice in this century. So it's anyone's guess on how this gets done this weekend.
Fun and games, it's always a mess. Ira Jersey, whenever I try and talk to people about this at the moment in the market, they just shake it off. They don't want to talk about it at all. Ira, what can we take away from this that means something to what you do every day?
Well, I think there'll be some volatility, and presumably one of the outcomes of this will be slightly slower growth in government spending over the next 4 or 5 years. And that ultimately might be modestly good for the Treasury market, because one of the things that's pushed Treasury yields so much higher of late is the idea that and the fact that we're getting larger deficits than the market was originally thinking. So there is a potential positive outcome for Treasuries in this whole mess, but at the same time, it's very uncertain, and clearly volatility in markets might pick up a little bit. Something important to note, though, John, is that this is not like the debt limit issue that we had back at early June. We're not talking about defaulting on the debt. We're not talking about treasuries not being issued. The Bureau of Public Debt remains open. The Federal Reserve remains open, and we will continue to roll over debt and issue new debt as well. So that is a whole thing is off the table.
Anne-Marie, final word on the GOP debate a little bit later. Is this going to be a feature of that conversation, fiscal austerity?
Oh, absolutely. Fiscal austerity, and also what these individual candidates would do in terms of their advice for their Republican Party in the House especially. And Jonathan, we've seen a wide spectrum of that. We know from reporting that Governor DeSantis has been calling some of them, saying, yeah, maybe potentially shut the government down. The former president, Donald Trump, who won't be there, be doing his own counter program, which we spoke about earlier, in Michigan, he said, hold the line, shut it down if you don't get everything you want. And then there's going to be others like Governor Nikki Haley, which says we have to keep the government open, but we need to also make sure they're doing their jobs in terms of fiscal health for this country.
Fox Business hosting that one a little bit later. Want to watch. AMH, thank you. Alongside Ira Jersey there on this bond market. Your equity market, better than yesterday, that's for sure. So far, at least. Let's see if this sticks. About 22 minutes into the session, we're positive here by 0.3%. Let's get you some sector price action. Here's Abby.
And John, based on the bearish action we've had recently, that's just the second up day in 7, but let's see if these gains hold. And sector-wise, it suggests that maybe that could happen. The composition is not so shabby. Energy, the best sector, up 1.3%. We also have communication services, real estate, tech up there. Utilities and staples and healthcare are among the down sectors. Actually, healthcare just flipping slightly positive. Those are defensive, so the fact that they're down, in a way, that's risk on. Over the last 3 months, though, John, and of course we are coming close to the quarter end, most sectors are down. Energy up with oil. Communication services also higher. But take a look at those rate-sensitive sectors. With yields going higher, those dividends look less well. Those sectors are worse, even down more than technology.
Abby, Thanks for that. Your update up next, the calendar for the week ahead, your trading diary, just around the corner.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Twenty-five minutes into the session, stocks higher across the board here. Outperformance on the Russell of small caps, the S&P up by 0.3%. That's the price action. Let's get to the trading diary. The week ahead looks like this. Donald Trump speaking to current and former UAW members at 8 p.m. Eastern as the second 2024 GOP presidential debate kicks off at 9 p.m. Thursday, the Fed speak picking up with Chairman Powell, Goolsbee, Cook and Barkin. Plus, we get US GDP and another round of jobless claims. And finally, the government shutdown deadline coming at midnight Saturday. I'm sure you can't wait for that. About 26 minutes into the session, your equity market just about positive by 0.3%. Thank you very much for choosing Bloomberg TV. Good to be back in a seat. Thank you very much for all the feedback over the last week as well. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that.
longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
If you're a busy professional who makes at least $50,000 per year and have been wanting to start a profitable business online, here's our offer.
The Writers Guild of America says it has indeed reached a deal, tentative though it is, with major studios to end the Hollywood strike.
The new labor agreement comes nearly 5 months after writers took to the picket lines. Terms of the agreement have not yet been made public, but union negotiators are calling the deal exceptional. They say it was only possible because of the leverage generated by the strike and the support and solidarity of other unions.
Elise Preston joins us now from Culver City, California with more. Elise, good to see you. Details are not public. Have we been able to pry anything loose? What do we know about what's in the deal?
Yeah, the details are not public. Good afternoon to you, Tony and Lilia. But we do know from insiders, they are also chiming in along with WGA leadership that the deal did swing in their favor. From what we're told, there are protections around the AI use. So the WGA had been asking for restrictions there. It appears that they have gotten those, as well as writing room minimums. They wanted to have more writers in the room as they are producing and writing this content. So those were two major sticking points that were holdouts for the last several days, or really the last several weeks, over this 146-day strike. And we are told that the writers were able to swing that in their favor.
So, Elise, the agreement still, as I understand, needs to be ratified by union members. Do we have an idea of the timeline for when that vote's going to happen and when we can expect to see people start working?
So it should be about a couple weeks before writers get back into the swing of things with work. We do know that the union leadership is expected to vote to end the strike tomorrow. And then that goes to the larger membership, and they have to vote. So keep in mind, there are 11,500 members in the union. They all have to vote before that is finalized and ratified. This is not the first time that the WGA has been on strike. In 2007, 2008, it was a couple weeks since they were able to get back to work.
And at least the actors have not reached a deal with the major studios as of yet. At least we've not heard anything, tentative or otherwise. Do we know where things stand with them? What needs to happen for those two sides to strike a deal?
Yeah, we're on day 74 for the SAG-AFTRA strike, and they have been asking for some of the same protections that the WGA had been asking for, but the actors are also asking for higher minimums. In addition to that, they want 2% of the streaming revenue, since streaming is such a huge way that people are consuming content now. The producers have already said that that would not happen, that that was a non-starter. So it'll be interesting to see. The writer strike was 146 days. We are on day 74 of the SAG-AFTRA strike.
Oh boy, we'll stay tuned. Elise, Preston, thank you.
I just lost thousands of dollars as a business until I started running my creatives on Snapchat ads. Right now, if you set up an ad account and spend $350, they will give you $375 in ad credit. Yup, $375. And now, this isn't some gimmicky course, but I want to show you why Snapchat can show you unreal results. It's their customers, it's their fan base, it's their tech. Snap users are connecting with their friends and family, and 9 out of 10 young people use Snapchat to communicate. 9 out of 10. Not only is the youth on this app, but Snap users have over $5 trillion in spending. Not pushing your business on Snapchat is just asking to make less money.
And for more on this, we want to bring in Reed Alexander. He's a correspondent at Insider covering entertainment business. Thanks for being with us this morning, Reed. I want to start with asking you about just how long this strike has been going on for. It's the second longest strike in WGA history. So without knowing the exact specific details of this deal, is this a win for the writers?
Certainly seems that way. The writers have characterized this deal after 146 days on the picket lines as, quote, an exceptional deal that they have reached with the studios. You heard Matt Bellany there saying that whatever they would have accepted would be far in excess of where the negotiation starting point was back in May when this strike was called. And the writers made very clear in all of this time that they were waiting for the studios to come and negotiate with them, that they were on the picket lines, that they would never accept anything less than what they viewed as a really robust deal with strong protections around artificial intelligence and residuals and many of the other issues at the heart of their fight. So one can only presume without seeing the terms that they're walking away with what they view as a victory.
Okay, what about SAG-AFTRA? Still not reached a deal with major studios. In terms of movement or concessions, what kind of hurdles do you think need to be crossed in order to see these two sides really agree on something?
Yeah, I think the SAG-AFTRA hurdles are, in fact, even more significant than the WGA hurdles, to be honest with you, because SAG-AFTRA is a much larger union, and it's a much more unruly union with 160,000 members versus the WGA's 11,000. So bigger constituency of people with a bigger spectrum of issues they're fighting over. Now, of course, some are similar. SAG-AFTRA, just like the writers, the actors are also worried about the encroachment of artificial intelligence and technology, but they're really, really far apart on wage minimums. And that is what is going to cost the studios far in excess of anything else that they're going to have to pony up for are these basic minimums that the actors are demanding to be paid. Residuals are going to be another big issue for actors because it's sort of harder for some studios to wrap their minds around increasing residual pay for actors who aren't involved in the development and the creation and the writing of new shows. So I actually think these next negotiations could be very complex. They may be burnished and given a boost, though, by having an archetype in the WGA contract that could feasibly speed things up.
I wonder what this kind of conflict or labor action says, Reed, about how our media landscape is changing.
I think in a couple of ways, certainly it says that the march of technology has been slowed but not stopped. All of this, the genesis of this fight that we've seen in the past 5 months has really been about the advent of tech in Hollywood with the rise of streaming, AI, and so many other tools that actors and writers and creatives have really worried are coming to encroach upon their turf, take their job, reduce their territory. I think there's been a clear message sent here, which is that the creative force is not going to bow to these tools and simply go quietly into the good night. However, this is a 3-year deal, and we've seen just in the past 3 years how the conversation around, say, generative AI has completely transformed from the beginning of the pandemic to now. It's gotten so much more sophisticated. So where we end up in 3 years is unclear. I think the big takeaway for media and entertainment is this. At the outset of the strike, I spoke to a young creative executive who had been laid off from her job at a large streaming organization. And I said, do you feel really despondent about the future of Hollywood? And she said, absolutely not, because I see what's going on and I see more people than ever who are fighting tooth and nail to protect the industry. I think the message that's been sent here is that there is not going to be a world in which the creative force goes away quietly and they're going to maintain their foothold in an industry that really needs them now more than ever. So, in some respects inspiring and in some respects also uncertain and unclear.
Okay, lots to follow here. Reed Alexander, thanks.
Thank you very much.
Forex.com, committed to helping improve your trading skills with innovative tools. Our exclusive performance analytics gives you personalized, in-depth insights for better trading. See your trade history from a variety of perspectives and uncover your least and most successful habits or markets. Plus, with Playmaker, another tool exclusive to Forex.com, you can monitor your trading discipline in real time, set your own trading plan, and protect yourself from emotional decisions. We've exclusively partnered with Capitalize.ai. Capitalize is a simple-to-use, plain English strategy creator, enabling you to quickly develop automated trading strategies to bring you seamless automation for a superior trading experience. You can backtest your strategy based on historical data. Start trading today with Forex.com to take advantage of these exclusive features.
Good evening and welcome to 60 Minutes. Every 10 minutes in Australia, somebody suffers a stroke. It's our second biggest killer and has left nearly 500,000 survivors living with crippling disability. But despite the dramatic medical advances in other fields, there's only so much that can be done for a stroke patient, which makes the work of one clinic in America so tantalising. Its results have to be seen to be believed. The therapy is controversial and heavily criticised, but the patients say it's truly miraculous.
Can you please count from 1 to 10?
Every minute of Linda Lumbra's daily life is a frustrating struggle.
One.
Welcome to the Coin Stories podcast, where we get to explore. Welcome to the Coin Stories podcast, where we get to explore the future of money, business, technology, and Bitcoin's revolutionary promise to boost economic prosperity around the world and mend our broken financial system. I'm Natalie Brunell, and I'm here to learn with you. This podcast is for educational and entertainment purposes only. None of the discussions should constitute as official investment advice, and you should always do your own research. Please make sure to subscribe to the show so you don't miss out on any new episodes. This podcast is made possible through partnerships with companies I trust, and I'm very picky about who I choose to partner with, so I hope you take the time to listen to the ad reads throughout the show. Thanks for joining me, and if you like this type of content and want to see more of it, make sure to hit that like button. All right, it's time for the show. Welcome back to the show. Joining me this week is Melody Wright. She is a strategist, author, and technologist. I heard about her for the first time from Danielle DiMartino Booth, who also follows all of her amazing research on the housing market and what's happening underneath the surface of our economy. So, Melody, thank you so much for joining me.
Thank you so much for having me. It's a pleasure to be here.
Well, before we dive into all of your research, I just want to hear a little bit more about you and how you got into this. Because one thing that you say on your Twitter or X page is that you're a great financial crisis survivor, and I can relate to that. I am too. So just tell me a little bit about your background and how you got into this work.
Yeah, so I fell into this by accident, which is what most people do when they get into the housing or mortgage space. And so, kind of showed up as a project analyst back in 2006. But it was at a really, of course, that year should tell you it was an interesting time. I was at a top 5 originator and servicer we were finalizing a purchase with Cerberus, which was private equity. And they needed to learn all about the mortgage business. And so I became their girl Friday, going across the company, kind of getting reports. And with them, I started understanding the business. And kind of from there, so I was in kind of the finance side of it, got sort of transitioned to strategy when we got into a lot of trouble, like the AG settlement, the consent orders. These are things from back then. That's when all of the banks sort of got in trouble for perhaps not following the procedures for foreclosure or default, things like that. So I helped out with that. And then our company, we held on for a long time, but we ultimately kind of had to file bankruptcy, which I helped manage as well. It was a very big bankruptcy at the time. We were the first company to go into bankruptcy and still originate loans. That's the first time it had ever happened. A lot of interest in our auction. But once I was done with that, they needed help with the default crisis. They needed someone to help manage that operational unit. So I went in and spent the next year just really traveling all across the country to help manage that crisis, as there were just foreclosures across the country, stuck, etc.
Wow. Well, so how did that whole experience, the great financial crisis, how did it shape you?
I think that it took a lot of time from my life, I would say. And we were in the office, in 2009, 185 days straight. And so we ultimately, it shaped me in the sense of, I believed, and so did everybody that I was working with at the time, that we were fixing things so this would never happen again, that we would never have borrowers and other people impacted in this way, and we would make sure that we were doing everything correctly. And that's what we believed at my company. And so it burned me so badly that I was pretty much very adamant, kind of in the companies that I went to after that, like, we have to do things right, because otherwise we're going to end up here again. And I can tell you that I never believed that we would, but I would say that, it was very, in a way, traumatic, just because it was just all encompassing when you were in these places that got TARP money, trying to survive, doing strategic alternatives. And so I learned a lot of lessons, but I don't think we did.
Well, as far as lessons go, let me ask you, what is the biggest lesson about what got us to that crisis that you learned? And what's the biggest lesson about our government's reaction to the crisis?
So if you had asked me, 2013, I would probably have a different answer. But what I have learned is that people were too focused on subprime and didn't really understand how the crisis unfolded and what really was the crisis. Because it wasn't just one thing. And I think a lot of people think subprime started, the GFC. Well, that was a liquidity crisis. That was a dollar shortage. And so that's very different from then what happened, kind of the peak of default didn't happen till, later, 2010, 11, 12. And this is when your prime borrowers kind of were impacted. So a lot of people just say, no, it was just subprime. Subprime was the kindling. And so what I learned is that narrative drives everything. That's what I learned, because we were all very, since that time, I've read a lot of studies. I've thought about even my own experience and realized that we got it wrong, what happened. And that's why we couldn't see what's coming this time around, because it was also an affordability crisis because of increased home values, which was then exacerbated by, what happened with kind of the credit event. But what did I learn about our government response? It wasn't productive. It didn't work. You had Rudy on, he and I talk about, I personally believe, I don't think TARP made anybody better. It made my parent company starved our servicing unit, which is the back end of mortgage. And that is why those mistakes were made. And so that money got funneled into marketing and other types of things versus actually coming into the organization and making us better. And so to me, as much as it would have been painful, I believe that we should never have sort of saved some of these entities. We should have let it, creative destruction happen. And we should have gone ahead and just gone through the pain at the time.
Right. Let the fever do its work so that we can actually rebuild on stronger footing. I know Rudy Havenstein is one of the people that always talks online about how quantitative easing and this massive stimulus and injection of money printing into the economy has created such asset inflation and really exacerbated the wealth concentration. And now people store most of their savings in their house, but for future generations trying to come up, they can't afford to get into that housing market. Once you could afford it on one income, and now multiple incomes don't suffice, and people just feel like they're, in this rat race. So let's talk about the housing market right now, because one thing I mentioned to you before we started recording is, when you look at macro analysis online right now, I mean, it's like a tale of two different stories. One is, hey, we're going to have a soft landing or no landing. Everything's great. We're chugging along really strong in the economy. And the other is, we're going to have a worse crisis than 08, 09. We're going to have possibly a worse situation than the 1930s, a second Great Depression. So talk to us about what you're really seeing on the ground, because you're traveling to so many of these markets and doing that on the ground research.
Yeah. So, what I see coming, and I talk a lot about the path, not prediction. And, I wish I could be the one that said it's all going to be great. But, we're kind of in the middle is what I call it, the messy, muddy middle, because I can remember very clearly back in 2007, 8, and 9, we also believed things were turning around. I remember sitting in a ballroom with our president, gave us all clickers and said, when do you think the housing market is going to turn around? It was like 9 or 10. I'm like, no, it's going to take longer. But everyone was looking at the same things they're looking at today. They were looking at these, very small moves in the Case-Shiller, which is what tracks home price appreciation, but does it on a delayed basis. They were looking at the same data, permits, applications. The problem is, when you look at all that stuff in aggregate, you miss so much of the story. I mean, even if they look at what they call the MSA level, which is kind of the metro, I think you miss the early moves by looking at that aggregate data. And something I learned being in the mortgage business is that you have to understand these local cities to some degree. Now, we're not superhuman. We can't understand them all. But what I'm really trying to do is kind of give them more bottoms up. And so what I'm seeing based on all of that and looking at alternative sets of data, more real time, especially around the short-term rental, long-term rental, things like that, is and the new builds, which are the most concerning to me in terms of just the amount of inventory I've seen out there. It's hard to describe in words, especially when everyone is screaming we have no inventory. And so, what I can tell you is that you have all this inventory that's going to hit the market because of affordability. So I think our path is not a great one.
Okay, let's dig into a little bit of that, because since 2020, since the pandemic, home affordability has just decreased by so much. I mean, because of the interest rates, monthly payments are up, but then also, a lot of money pooled into this asset class, so the home prices are inflated as well. So what are you seeing in terms of just inventory across the country? Because I know it's sort of different depending on the area, right? A lot of people, for example, like myself, left California. But one thing that I'm finding is here, I live in Missouri now. Here, I'm starting to try to, look at real estate, and houses go in a day, no inspection, contingency, all cash offers. So it's super confusing, because on the one hand, I'm like, we're about to hit a recession, things are slowing down and houses are unaffordable. On the other, I try to, look at some real estate personally, and they're flying off the shelf like hotcakes.
Yeah. And I think that has a lot to do with the small mom and pop investors that are kind of coming in at the end. And so it's still very shocking and surprising to me that, we've seen articles. A lot of us have been talking about the short-term rental craze being bust for some time, but a lot of people haven't gotten that memo. And they talk to their friends, and or they talked to their friends 6 months ago, and everybody thinks this is a way to make passive income. And I can tell you, I still oversee books, and a lot of these are still investment loans. And so there's way to, for the all cash sales you're seeing, people will go out and get other types of leverage. They'll either cash out of a bigger property. They'll take out a loan on their crypto or their equity assets, and they'll show up with all cash. And one thing they'll do is that coming soon, what that really is a way to do is to put the listing out there. And what you don't realize is they're marketing that to a select group of people behind the scenes. And that's how they do an end run around like National Association of Realtors, the MLS. And so that's why you're seeing it was sold, because they've been actually marketing that for 21 days and talking to people before you even get the opportunity. And they do that as a way to get an edge in the market. And so there's the macro piece of the investors, the small mom and pop, because the institutionals have pulled back. And then sort of like your realtors, your brokers, these people on the ground that are doing their best to make every dollar they can, if that makes sense.
Yeah, I mean, that literally happened to me. There was a listing, and it was coming soon.
Right.
And the second that it was actually available to the general public like myself, it was already gone with an all cash offer. And I was like, wow. But okay, so you said we're kind of muddying through, and how bad it got in the great financial crisis. So what are we barreling toward right now? It's time for a quick break to hear these messages from my partners. First up, Bitcoin Amsterdam. The biggest Bitcoin conference in Europe is just around the corner. The second annual event will be held October 12th and 13th and bring together speakers from around the world, including the one and only Edward Snowden, Stella Assange, Balaji, Eva Vlardingerbroek, and so many more. Get your tickets with a 10% discount using code HODL. And don't forget to get your early bird pass to Bitcoin Nashville 2024. You're going to get the best price right now. And again, use code HODL for that discount. I'll see you there. Next up, Fold. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase, from Amazon to groceries to your Bitcoin conference ticket, with Fold's Bitcoin cashback debit card. And you can play to win free Satoshis or even a whole Bitcoin by spinning the rewards wheel. This is a great app to get someone totally new into Bitcoin. And it's way better than earning reward airline miles and hotel points. Head to foldapp.com/Natalie and you'll get 10,000 Satoshis when you sign up for Spin or Spin Plus and spend at least $20 on the card. All right, back to the show.
So we've got a lot of oncoming trains that are all headed to the same destination. And so the timing's a bit tricky, but on the one hand, you have an affordability crisis, especially for these people that bought in 21 and 22. Increasing property taxes and insurance I've seen escrow notices go out where, they basically say, let me look at your insurance and tax for the next year. Now we've got to increase your payment. I've actually seen notices go out that are 2 times that original payment. I mean, and that's happening on investment properties. And so, and it's also happening to your regular folks. So they themselves didn't realize when they were getting that loan really what was coming in terms of these added expenses. And then when a lot of them do things like waive the inspection, they could have replacing, an air conditioner, roof issues, all kinds of things. So you've got affordability just crashing down on these folks. And so I'm very different, where a lot of people think that, okay, we have to have some kind of either a credit event or we have to see a lot more unemployment. I'm seeing already, like, even if we didn't have those things, you're going to see default. Now, there's a lot of government programs out there, as there was during COVID, and they'll catch some of it. But there's just been so much government lending since 2009. We've actually doubled the amount of mortgage-backed securities in our government, kind of taking the place almost of those private loans that caused the issue last time. And so those folks themselves, they're going to struggle and probably not be able to even get a workout that's going to work out for them. So that's one. The affordability is a big problem. And then, with home prices where they are today, I'm of the belief that rates are important, but home prices are really what's crushing affordability. There's just not going to be much. There's nothing rosy in the future. And, I think everybody thought we were going to get rich. And I think it's slowly sinking in that those wage increases aren't going to come. But if they do, it's usually going to be through a battle that's going to take time. So it won't be overnight. And then they're not the pay increases too that could really make this a different kind of mortgage market in the foreseeable future. Everybody's banking on rates going down. Yep.
Well, it was recently reported that the average or the median income has actually gone down, especially in terms of real purchasing power because of inflation. And with those mortgage-backed securities, we've kicked the can up to the sovereign level. And so we are so much more leveraged in general. I think this week it came out $33 trillion of debt the U.S. has. Okay, so first, I have a question about just inventory in general coming online, because one thing that you do talk a lot about is sort of that Airbnb and like all the vacancies that happen, because as you mentioned, people thought, oh, if I, take out some debt at low interest rates, I can purchase a property and rent it out and it's passive income. And here I am, I'm going to take a vacation with all that passive income. But a lot of those, they're basically, there's too much supply and not enough demand. So those might be coming on the market, but aren't those mostly, let's say, apartments, condos, or multi-family homes, as opposed to a single family home that you might want to, raise your kids in and actually stay in for the length of a long mortgage?
Yeah, so it depends, but not mostly. So there's a lot of different great data sources out there, but you can look on average about 75 to 80% in aggregate. Some much higher are actually whole homes. And the other thing I was just talking to a follower about is that, so when you go and search something on Airbnb's site, for instance, they're going to say 1,000 plus listings in this area. So when you go search Austin, it'll say 1,000 plus. It won't tell you how many. Won't tell you that there's 14,387 in Austin. Nor do they tell you explicitly that when you search in Austin, you're only going to get 300 shown at any time. So this is a big kept secret of how many of these short-term rentals are in these locations, because everybody went crazy thinking that COVID trend was going to persist. And then there's the underlying technology that people were using to kind of justify the mortgages on these, or even justify purchasing it with an all cash, would say something like, you're going to make on average $600 a day, and you'll be occupied 55% a year. None of that was accurate. That wasn't like looking at good comps. That was looking at maybe the travel boom year when we couldn't really go overseas. And so everyone, I track over 70 cities, and each one of them, if you look at these, it just blows your mind, because we also have hotels in most of those cities. Yeah. So that's I think that people underestimate how much of this is out there, and they think, okay, maybe it's multifamily. Like in New York, 26,000 are listed, right? That's not all, single dwelling, but there are a lot. And so, again, around that 60% range, I think this is going to come. And even if a little bit of it comes, then that's enough. And then you layer on the built for rent, which was people building for long-term rental because they wanted to get in on what Wall Street had done at the end of the last crisis in 2012, 2013 and up. And that is a lot of the inventory I've seen out there, just whole subdivisions built for rent, while at the same time you have multifamily going gangbusters, more than we've ever had since the 70s, and we don't have the demographics to support it. So those are two big pieces. And I do believe Wall Street is kind of backing out. They've become net sellers of built for rent. And so, I think this is all going to start. It's already started in many cities. This is when you look at the aggregate numbers, even those are ticking up finally, they're finally ticking up. But you get lost because you're not looking at these specific markets. And so you're not seeing those early trends. And then on top of that, if seniors can sell their existing homes that they've had for second or third homes, and they can make 5% or more on their cash, people are going to start to do these things. And you can already see it happening. And that's why I think a lot of people they're looking backward and they're saying we didn't build enough. Well, but we've got to look forward. What's our population and who's going to be able to afford it? And what about these boomers that are retiring and won't be sustaining these homes anymore, and their kids won't be able to either because they simply won't be able to afford it.
Well, right. I mean, it's really shocking to see how high some of the monthly payments are, and how, just a couple percentage points makes a massive, massive difference. And obviously Federal Reserve Chair Jerome Powell, he's so adamant on remaining higher for longer. I'm actually surprised by how much our system has been able to sustain the higher interest rates, and the speed at which he increased them. And they've kind of, plastered over some of the leaks and saved the day when it came to that the banking crisis a couple of months ago or earlier in the year. But I do feel like everyone's sort of expecting eventually some sort of an event, a credit event, and they're going to have to come in, lower the interest rates, and print again. First of all, do you agree with that? And second of all, wouldn't that mean that, hey, interest rates are going to come down, money's going to be pumped in, houses are going to get even more expensive in terms of the price, but cheaper in terms of your monthly payment, so more money's going to flow into this space and we'll avoid a housing market crash?
Right. So I think the banking crisis is still happening. I think that, the news pretty much tries to make us think, it's all taken care of. But in reality, I follow the Eurodollar markets. I follow the behind the scenes, and you can see the dollar shortage. You can see the credit crunch having its impact, and they're being very quiet about it. But an article came out this week about the FDIC not being able to sell some of these assets. It is only a matter of time. It's about contagion. And last time around, we were actually the virus because of that private equity purchase. We had to take write-downs, and we took them way before other people because they wanted that purchase price adjustment. And so we led the way, and it takes one, and I honestly believe these assets that aren't being sold by the FDIC, which are very similar to other assets sitting on other banks' books, that this is the fire starting. And so that crisis isn't over. It's just that people have stopped talking about it for the most part. But to your second point about, there's going to be a credit event. Well, what happens during a credit event? I think this is what everybody forgets. Credit event, Lehman falls over, Bear falls over. Well, what about all those jobs, and then what does that do about all of those people that are, it's a system. And so when one falls, it's because something's wrong in the system. And so if we have a credit event, we will have layoffs. We will have, people who have lost a lot. And thus, lowering rates isn't going to help anybody except for those that kind of survive that, And honestly, everybody talks about this demand. Well, it's demand at a certain price point, and a certain payment, which includes those rates. And we're not anywhere close to that. And so lowering rates is not going to help. And then layer on top that we're probably going to be in pretty dire straits if that's what's happening.
Melody, can you talk to me about inflated credit scores and, what you're seeing sort of under the surface about whether people who got mortgages can actually still afford them coming down the pipe?
Yeah, so we're actually seeing early delinquency in our FHA and VA population, as well as it's just now starting in our prime Fannie Mae and Freddie Mac population. And I think that that ultimately has something to do with the fact that credit scores were inflated during COVID. One, because medical debt was not treated the same way as it was during the GFC, a lot of leniency there. And then also on the student loans, the way that that was calculated was off of a much lower payment amount. So let's say it was like a $250 when in reality your payment was $1,000, and so it just made the credit profile of these borrowers seem better, not looking at the affordability of really could they be able to pay back.
Wow. Okay. And so you can kind of see that if you're originating a loan, you punch in these numbers and then the loan gets approved, right? If there's a certain ratio,
That's
but
right.
those ratios are dramatically changing.
They've changed, definitely. And I think this is something people talk about all the time. Like, you cannot read an article about 2008 without what I call credit quality gospel singing, which is talking about how credit quality is so much better. Well, firstly, like, let's look at our government loans, FHA, VA, those credit scores are in the 600s. I mean, those loan to values are very high, with only 3% down. I mean, and even the GSEs were doing programs last year of 1% with certain homeowner assistance. So, we truly were not looking at an ability to repay in a normalized market. And so I'm seeing where I didn't expect to see deteriorating credit quality this fast. I actually believe things would happen in the super prime first, and we are seeing that. That's where you're seeing the investors walk away already. But I'm seeing degradation in borrowers with mortgages much faster than I anticipated, because they can't repay, especially with those increased insurance and property tax costs.
Well, right. And the COVID programs are ending. People have to start to pay back their student loans again. But if they can't, won't the government just rush in and help them, or no?
They absolutely will. They'll try, but when you go back to the GFC and you look at those programs, they weren't successful for many, as you know, right? Like they weren't. People couldn't repay no matter what, and they're very strict about these modification programs. And if you can't qualify, you can't qualify. A lot of times, the servicer you're working with has no choice in that. That's a Fannie Mae, Freddie Mac, FHA. So yes, there will be a ton of government programs, but with my experience in default, I can tell you there's just a good majority that just they can't even qualify for those either. They can't make those payments because the affordability is just getting crushed. And when you double your payment, I mean that's a big expense that you weren't expecting. So
It's time for another quick break to hear these messages from my partners. Next up, CoinKite, which offers everything you need to safely take custody of your Bitcoin. CoinKite produces the Cold Card Wallet, which is the cold storage device I use for safekeeping my Bitcoin. You can verify the source code, it's ultra secure, and it's easy to use, even if you're a beginner. Head to their website in my show notes to find all of their custody products, cold cards in different colors, seed phrase plates, tap signers, purchased in the last couple of years, they are struggling to make payments. I mean, the reality is, despite what economist Paul Krugman says, inflation has really hit people. Your income is not keeping pace with the cost of everything around you. And so people are really, suffering. And those that got their house on a really low interest rate, they're kind of locked in right now. But do you essentially see something ahead of us in the next year or two that is worse than 08, 09 and the experience that some of maybe my viewers and listeners had during the great financial crisis? Because my family, we lost our home. We were one of the 10 million American families who went bankrupt, lost their home. And of course, the big banks got bailed out, but not the American families.
Right. And it's generational too, right? So like my family, we lost our home as well back in, the late 70s, early 80s. So, what I've started to realize is this is kind of what happens is you get whole groups of people kind of wiped out, by these events. And so is it going, I feel like people get lost in the, let's compare to 08 and everybody just starts, no, it's not going to be the same. Like to me, it's going to be, if it plays out, which at this point, I don't know how it doesn't. I think it is going to be somewhat worse because we're actually, I believe, based on how much debt we have and things like that, that Wall Street won't be able to come in and save it. Now, the government likely will. They'll probably get there first. But remember, they were a big part of it last time. Fannie and Freddie were the ones that pushed those sales out to Wall Street. And so I think you're probably going to get government really involved. I think suddenly everybody's going to wake up to all this inventory and, you're going to have write downs all over the place. And so I do think that it could be worse. And I think it could take some time to play out unless we have an exogenous or a credit event. And then I think things could speed up. But I think you're looking at a 3 to 5 year downturn if things go like just the path that we're on right now.
Okay, so given what you just said, when would a good time to buy be? And I'm asking this for a very personal reason because as much as I love my Bitcoin, I can't live in a Bitcoin. And my dream ever since my family came here and what I really see as, accomplishing the American dream is owning a house. I've never lived in a house where I didn't have neighbors above me, below me, to the side. Like I've always dreamt of having a single family house. And every year it feels less and less within reach, even though I'm working hard and maybe I'm, achieving more in my career. It always feels like it's like one step further out of reach. And maybe people can relate to that. So when do you buy? Do you wait for that sort of downturn? Or do you go now because you can refinance? What are people supposed to do?
Yeah, so it's horrible, and I wish that I wish I had a better answer. But I unless you have to, and there's death, divorce, default, and the DOD for reasons people will have to move that are not their choice. Okay, and so those people, I say if you have to make a choice, please reach out to someone like myself. And we can talk through it because there's better choices to make. But, I don't think it's realistic to tell someone you're going to have to wait 5 years. But I think you're going to have to, if you're in it for the long term, you're going to have to understand the risk and there's trade-offs, right? I think you can make better decisions. And I hope after this, I can actually give you some tools where you might be able to get ahead of those people that are marketing in the background and then negotiate, So I wish my answer was that, wait a year and everything's going to be fine. I think it's a little more complicated than that, but I think there are markets where you'll be able to get an edge in within the next year or so. But just don't do it blind and don't go in listening to the people that are going to make money when they sell you that house because their interest is in their commission and not, that puts food on their table. Let's put it that way. Right. So yeah. And I know that's not a great answer, but I think that, just talk to somebody like me or someone, and it will depend on your market, and there will be better choices to make probably within the next 6 to 9 months, honestly.
Okay, that's really good advice. Before we start to wrap up, I wanted to ask you about HOAs because there's the mortgage payment and there's your principal, your insurance, all that. But wow, sometimes I look at homes and I go, how is the HOA this high? I mean, have you done any research in this space, and how are people affording HOAs?
So they're not, and it's just one more thing that they don't even think about. And then the fact that I always caution people to read their CCNRs and what those are the covenants of the HOA, because if they can do something like raise your fee without any kind of process, they just come to you. You don't want that, and it is a very critical part of your decision. I don't know how people afford it, but usually they're not even thinking about it, and they're not thinking that it's going to get raised. And the HOAs during a crisis in the super lien states, they will take priority lien, meaning they will foreclose that house faster than your bank or your non-bank.
It's wild. I mean, I had no idea, especially when I was young, thinking about, someday having a house. I never thought about these extra fees. And I'm sure some homeowners associations are great, but I got to be honest, I've served as a reporter for many years. There were some issues with some of them, and it's like a local small government. So obviously there's corruption and there's politics at local level. So tell me, in the markets that you researched, yeah, exactly. In the markets that you focus on, tell me the one that's maybe the best, the one with the least amount of problems or the most opportunity for people who are looking for a home or are current homeowners, and the one with sort of the most problems under the surface where you're like, oh my gosh, something's about to crack.
Yeah, so right now the Midwest is probably your best bet in terms of getting affordability and not these double digit price appreciation, but that's quickly changing. Like somewhere like Cleveland, places like that. But then you also have to think about, okay, does it have the school system I want? Does it have, all these different things? But from affordability, places like Cleveland, places like Columbus in Ohio are kind of really the last place. And honestly, Missouri, listening to you say this to me, it's telling me the investors are probably there because it is one of the last markets.
Yeah.
So yeah, but every one of these markets people move to, they buy, and then it becomes unaffordable. So it's just the same, loop. And then I think any of these Sunbelt cities, reach out and talk to me. Do not purchase in Nashville, Austin, Charlotte, Phoenix, and especially down here in Orlando without really doing your homework. And don't, again, not what they're telling you, not the pamphlet they give you, not the brochure. You really need to look at the demographics. You need to look at what the future may hold for that area, what other investor activity maybe is going on. So you really need to be knowledgeable about that market in a way that most people aren't used to being.
Well, you named a lot of places where during the pandemic, everyone was flooding to those areas, the Nashvilles, the Austins, the Florida, Miami, Orlando, especially from where I used to live, California. Okay, so to wrap up, I really want to get your thoughts on Bitcoin, because one thing that we talk about on the show is that Bitcoin is this form of digital property, and so many people, like I mentioned earlier, store their whole wealth in their house, but there are maintenance costs, right? And there are all these other hurdles when it comes to that as an investment class that maybe Bitcoin doesn't have. But are you a Bitcoiner? What do you think about Bitcoin? Do you think Bitcoin will help people buy their dream house someday?
Yeah, so I think I've changed my thought around it over time. At first it looked just speculative when it was going crazy. I kind of started studying my macro, in late 2021. So I was like, what is this? And I'm not a gambler by nature. So I was just like, no, like this doesn't make sense to me. But then as I got more into macro, as I understood, kind of our monetary system, the injustice that we all see that's happening based on quantitative easing, this asset price, acceleration. I definitely see the efficacy. I see that this is important, and I think it's important for people to push an alternative. I have to be honest that I'm a little nervous about, central bank digital currency and our financial repression and people coming in. But on the whole, to me, this is something, this isn't the technology I like, number one. And then number two, I like it as an alternative, and a way to kind of protect yourself for what's to come. I'm a big believer in diversification, no matter what. But I've definitely changed my thoughts on this, and actually really agree with a lot of the principle behind Bitcoin.
Well, that is so great to hear. And I hope we get a chance to chat with you more, because one thing is, if you made the right decision about Bitcoin years ago, houses have been getting cheaper for you in terms of Bitcoin, which is really nice. There's a mentor that I have in the space, Jeff Booth, an author. He says that it will demonetize real estate and bring it down to more of its utility value. These houses, like, you're supposed to live in them. They're supposed to be valued based on the utility that you get out of them. And it's so funny when I see these posts, right, where the house was purchased for, like, I don't know, 60, 70,000 in the 70s. And now it's a couple million and it's like falling apart. But, someone's got cash to purchase that property and redo it. And it's just wild what we've done to the market. It's wild what asset inflation has done to our country.
Most of it's leveraged. Yeah. So
Exactly. All right, Melody, this has been so great. Any final thoughts, and how can people find and support your work?
Final thoughts again, a lot of times you're going to have to make a decision. So just, reach out to someone like me and be thoughtful about that decision. Please don't go into it. Please don't waive a property inspection, et cetera. And hold on, because I do believe we're going to have a correction. And I do believe that price will meet affordability. But you can reach out to me on Twitter at M3_Melody, MELODY. On LinkedIn at Melody Wright, WRIGHT, on Substack at M3 Melody Substack, and then on YouTube, M3 Melody YouTube. So, bunch of
your
different
Substack
locations.
is great. Yeah, your
thank you so
Substack
much.
is great. Melody, thank you so much for the work that you do. Really grateful that I found you thanks to Danielle. So shout out to her as well. Melody, I hope you come back on soon. Thank you.
I've enjoyed it. Thank you so much for having me. Thank you.
Thank you so much for checking out the video version of my show. If you want to see more content like this, make sure you're subscribed to the channel and hit like on the video. And please reach out with feedback or guest suggestions. My email is natalie@talkingbitcoin.com. I'll see you next time.